Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're talking about retirement accounts a bit, a bunch of things here related to if you think about it basically on your retirement accounts and your investing, there are different rules depending on the type of accounts you have. So if you've got retirement accounts, whether it's IRAs, 401k, TSP, whatever kind of account you might have, those have certain tax rules that are different than the investment rules, if you will, that you're going to be dealing with. So when we're talking about money outside of retirement accounts, different tax rules again, and different but the investment rules are going to be about the same. There's some exceptions to this though. So for instance, if I've got money in a retirement account and I've also got money in a non-qualified account that's just regular savings, if you will, this is understanding how the tax laws would dictate how I invest. So for instance, if I've got $500,000 in non-qualified funds and $500,000 in IRAs or retirement accounts, right? Let's say I want my investment rule is saying that I want a moderate portfolio, let's say, and this depends on your situation, okay? But if in your situation, we determine, let's say that the amount of return you need to maintain your standard living, quality of life, income needs, all your financial goals, let's say that return needs to be somewhere around 5 or 6% a year. Okay, and to understand, I've been talking earlier about, we made 29% last year, and if you look at we're in the longest bull market in history, and the average return on the S&P over the last 10 years has been like about 14% a year. When we look at those kind of numbers, we think we might get a little starry-eyed and think, ooh, I want to get double, I need to make double digits on my money. Not very realistic. Okay, in the next 10 to 20 years. I mean, I don't have a crystal ball. No one does. No one knows what they bring. But when we look at some of the best minds out there and the biggest players in the markets, companies like BlackRock, for instance, they're the biggest money manager in the world. They manage the federal employees and military accounts, the TSP accounts, as well as a number of other large corporations in that. When you look at people like Dr. Robert Shiller, won a Nobel Prize in 2013 in economics for his equity research and the Shiller Cape Index that he developed, which has been a very big, very accurate predictor of 10-year plus market returns. When we look at McKinsey, a large global research firm, and we look at Vanguard, if we look at Jack Bogle before he passed, he talked about these same things. And what I'm getting at is that over the last 20 years, the market's only averaged about 5% a year. So even though in the last 10 we've had this nice, great run, we have to be practical in understanding that there's a cyclical nature to the market, and we're going to have recessions again in our economy, which are usually going to preface a bear market as far as the stocks go. So we've got to watch all these things, and if we look at it and be more practical, more realistic, all of the people that I just mentioned, their predictions over the next 10 to 20 years are 5% a year returns on average. And that's both here domestically as well as globally. Now, we may do better, but when it comes to planning, we want to figure, well, what do you need? What is the needed rate of return on your money to not run out of money and be able to maintain your standard living, quality of life, have some fun money in retirement, all the different financial goals that you might have? What's the needed rate of return to accomplish those goals? So for instance, a moderate portfolio, say a balanced growth portfolio, 50-50 stocks and bonds. If we look at it over the last 20 years, it's averaged, I think it was between about 5.5%, almost 6%. If we then look at the last the last 10 years, however, that same portfolio is averaged closer to about 10%. All right, so this is where, again, not all, just because you have, whether it's a 40% in stocks, 50% in stocks, or 60% in stocks, all fit this moderate balanced growth strategy. Okay, but just because you have that mix doesn't mean that you're going to get that type of return. Remember, again, the asset allocation models we're using, basically forming on if we look at Dr. Fama's three-factor model, those are the returns that we see on the model portfolios over the last 10 and even 20 years. So how is it going to be for you, and how do you plan for these things and understanding this, right? So if we're looking at that moderate growth portfolio, And we're going back now to how do you invest then when you're looking at your retirement accounts. And I mentioned if you had $500,000 in your IRAs or your 401ks, combination, whatever, $500,000, it's in non-qualified accounts, again, regular savings, brokerage accounts, that kind of thing. How do you invest those monies? Well, understand, here's a tax rule. When it comes to investing with bonds, bonds pay interest. That interest is taxed at ordinary income tax rates. So right now, if you're in a 12% or a 22% or 25% or whatever your bracket, excuse me, 24%, whatever your tax bracket is, understanding then that the interest you're receiving from those bonds is going to be taxed at that rate. Okay, so if you've got income from pensions and Social Security and what have you, maybe you're a married couple, and you make over $100,000 a year, you're in a 22% bracket, and that interest then that's coming in on top of all your other income sources is going to be taxed at 22%. However, if you had gains that you were taking from stocks, right, it would only be taxed at 15% in that same situation. So you get a nice tax break there. So therefore, if I've got money that's invested in bonds, here's something else that's important to understand. My IRAs or my retirement accounts, they're always the money. When I start taking that money out, it's going to be taxed at ordinary income tax rates. Remember that 22% if you're making over just over 100,000, let's say. So now you're at 22% tax versus a capital gains rate we talked about. However, capital gains rates don't apply to your retirement account money. So those IRAs and 401ks and that, you're again at ordinary income tax rates. How can you in fact improve upon that? Well then, if I've got a 50-50, let's say, strategy or whatever it might be, it could be 60-40. The point of it being that I want my bonds to be more heavily weighted in my retirement accounts since they're taxed the same. Retirement accounts have ordinary income tax rates, bonds have ordinary income tax rates. And I want my stocks, my equities, to be more in my non-qualified accounts because then I can get preferential capital gains tax treatment. All right? So this is just a very simple strategy on how you construct your portfolio where you still maintain the strategy that you like with regard to investing in the market, in other words, that moderate strategy, but at the same time you're aware of the tax implications of your investing, so therefore you maintain, let's say, that 50-50 model, but now you're going to have more of that money in the bonds, that is, in your retirement accounts, and more of the stocks in your non-qualified accounts. It could be even, if you had as I mentioned, 500 in each, you might have all bonds in your retirement accounts and all stocks in your non-qualified accounts. That's going to be the most tax efficient. Now there are other tax rules that come into play as well, as far as Roth IRAs as an example. So understanding how those work and how you can utilize that to your advantage. When it comes to planning, this is one, I get a lot of calls to the office, and one of the things that's asked is whether Roth is a good idea for you. Okay, so you may wondering, well, is that a good strategy for me? Understanding, or they're asking questions like, well, should I put money into a Roth instead of a traditional? There are a lot of rules that go along with that in making that kind of choice. There's not a generic answer. So Roth can be very, very powerful in terms of your retirement planning, giving you tax-free income, giving tax-free income to your beneficiaries down the road if you don't use those monies up. So it has some tremendous advantages. But understanding that to get there, you're going to be paying taxes today on those monies. So if it's a choice of do I put money into a Roth or a traditional, well, it kind of depends. If you're in a 10 or 12% bracket, I would say yes, probably the Roth is going to be better. Why worry about saving 12%, let's say, on my taxes, okay, on that amount of money? Better that I would be able to, when I take it out, and maybe my tax rate might be double that, all right, that I would pay less in tax. Just with the sunset provision in a tax code that'll be coming up in 2025 alone, that 12% is going to jump to 15, right? So you're talking a 25% increase in your taxes, okay? So you can see it gets a little more complex, and this is why I give you the rules, because I want you to then seek out some advice on how to do that. Find people that understand it, or call my office and I can help you with it. All right, so that number again, 615-376-2525. 5325. If you'd like a personalized plan, if you'd like to see, for yourself whether Roth strategies would be to your advantage and how to implement them to minimize taxes in the process, then that's part of this planning. 615-376-5325. If you're one of the first 10 callers, we'll get you in for an appointment. We'll do up a comprehensive plan. It may take 2 or 3 visits. There's no charge for it. It's an opportunity for me to basically help you, as well as introduce some of the services that we provide. And if it's a good fit, maybe you'll become a client. But again, no obligation to do so. There's the number, 615-376-5325. And when you get into these Roths, and you're talking about in particular, if you've got hundreds of thousands, millions of dollars even in your retirement accounts, the tax implications when it comes to your required minimum distributions, this is one of those areas where Roth can be very important to you, or having a Roth strategy over time and implementing it. We'll help you with that, as well as all the other things that we talk about here on the show that we can help you with in this comprehensive planning. So again, 615-376-5325. If you'd like to see your financial future based on the things you're doing, and see and learn strategies to improve that picture, save you. Most clients come in, we're saving them tens, maybe even hundreds of thousands of dollars over the lifetime, all right, with the planning that we do. So again, 615-376-5325, and when you call in, Tess will get your information. She'll send you out a checklist of things to bring to your appointment with me, and when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom and Retirement. And we talk about a lot of these things in the book as well. All right. One of the things, back to this about your retirement accounts and understanding that, the basics of that. When you're doing a traditional IRA or 401k, of course, you're being able to put money in, and that money that you're contributing is not taxable to you that year. When you take the money out, you've been able to grow it tax deferred over the years, so you're earning money on the money you would have otherwise paid in taxes. It's all really good. And when you take it out, it's going to be taxed at ordinary income tax rates. All right. Then when you're talking about Roth IRAs, of course, and Roth 401ks, when you're putting money into Roth, you do not get a tax break up front. When you take the money out, though, it's growing on a tax-deferred basis, and as long as you follow the rules of Roth, you take it out in the future, and it'll be tax-free to you. Now, understanding the new Secure Act, this is one of those areas that is impacting. So with IRAs and 401ks and alike, we know prior to, in 2019 and before, if you turn 70 and a half up to those years, you're taking required minimum distributions. Required minimum distributions mean that you have to take out what starts out at 3.75% in that first year, and each year that increases. The percent you have to take out is incrementally increased each year, because those RMDs then are going to be getting bigger and bigger, and then as your account grows, of course, another reason they'll be bigger. We do the analysis that I do with clients is showing them what their RMDs are going to be if they're not already taking them, and then we plan around whether we do these Roth strategies, among other things that I mentioned. So when you're taking RMDs, what just changed? The Secure Act that passed now raised the limit, so if you turning 70 and a half in 2020 or beyond, now for you don't have to take those required minimum distributions until you're 72. Okay, so that age got raised. Now, unfortunately, there's some other things that aren't so positive about that act, and we're going to talk about that when we come back from this break. Join me here. We'll be right back on the Retirement Report.